This market sell-off created opportunities for value investors like us. Unfortunately, not all stocks in our watch lists are still not in our buying range. Hey guys, I'm the Newb investor. I screened the top 50 US stocks by market cap through our three metrics, so you won't have to. I used Finviz to screen those stocks by market cap and by country, USA. Of the 50 stocks, I'll tell you how many of them are still trading at overvalued, fair, and discounted prices. But first, let's go check the stocks first with Finviz. Just go to Finviz, then click the screener, go to country and click USA. Then double click the market cap to make the descending order from the highest market cap to the lowest. Take note that we'll only use one BRK or one Berkshire stock and one Google stock. So we have to move two more stocks down. So the stocks I screened started from Apple down to Morgan Stanley or MS. Take note of the date also, March 9, 2022, because I based the prices and PE data from that day. I'll upload and put the Excel in the description below for your viewing. Of the 50 stocks, 16 stocks trade at discounted prices. We have here the banks like BAC, Bank of America, Wells Fargo, JPM, and Morgan Stanley. Semiconductors like QCOM, AVGO, Intel, TXN. We also have tech like FB, ORCL, and healthcare, Pfizer, Merck, and credit card services like Visa and MasterCards. We also have BRK here and Verizon. 5 stocks trade at fair values like Microsoft, Google, McDonald's, AT&T, and UNP. And 29 stocks still trade at overvalued prices or at a premium. Only 6 stocks made it to my strong buy, which we'll review later. 15 stocks made it to my watch list. These are stocks that are in my range of buying, meaning they're trading at discounted or fair values. And 29 stocks I'm still avoiding at these prices. How did I get this? If you haven't watched my videos, I screened the top 50 stocks in the US by market cap through our three metrics, through our three metric analysis on these stocks. By these three metrics, I can determine whether the stocks are trading at overvalued, fair, or discounted prices by looking at the relationship of EPS to their PEs in my first metric, the relation of the PE to their yields in my second metric, and lastly by comparing them to their historical PEs. Let's do an analysis on FB stock. So if ever you have decided to download this spreadsheet below for your viewing, you'll be able to understand what and why these components are there. FB is currently trading at $190.29 with PE ratio of 13.82. The company does not give out dividends. We'll use this data from here to do our metrics and their financials, which I got using Seeking Alpha, and I cross-checked it in Macro Trends and Yahoo Finance. First metric, we want an EPS multiple lower than 3. It is 1. Why 3? It's just how I screen my stocks usually. We get this by dividing the PE by the EPS, trailing 12 months. This means we're paying FB stock, if we buy at these prices, 1 times their current earnings. I've included here the EPS history in case there's an anomaly in the PE that skews the whole metric. Also, here is OSN, or outstanding number of shares. We want their EPS to be increasing and their OSN decreasing. Below is the payout ratio. If you want to buy stocks for dividend, you might want to check out their payout ratio. I personally want it below 60%. Second metric, we want to pay $1 or less for 1% of the money they're making. This is based on the lowest yield of both the net income and free cash flow yields of the current year and the 5 and 10-year average yields. The more data, the better. But when I screen this, I only use 5 years of data. What you see here is revenues deconstructed, the costs and expenses they use to make these revenues, and how much of those revenues they keep in income or free cash flow. The above values are in billions, below is in percentages of their respective revenues. I'll show you the relationship of the sales. I've included here also the revenue growth as my second metric, or any other process for that matter does not account for the loss of revenues. Their yields will still be the same with declining revenues. That's why it is important for companies to either maintain or retain their current revenues. Of the four highlighted values, we'll take the lowest yield to divide our current PE, and we'd get a discount of 0.43. This means we're only paying 0.43 times their earnings if we buy at these prices. That's saying we're paying $0.43 for a dollar. Last metric is historical PE. This one I took from Guru Focus. We'll take the average PE to divide the current PE, and we'd get a discount of 0.39. This means FB stock is trading at a lower PE now compared before. In conclusion, the stock beats all of my metrics. FB stock is trading at a discount, 1 times their earnings, 0.43 times their yields or margin, and trades at 0.39 times cheaper PE. This here means I own the stock. Should you pay premium for the stock? Yes. If their revenues are growing, bullish investors do pay premium for these stocks. Next is, would I buy? Yes. Actually, I started a small position at an average of 201.22. You'd see here my fair values. If you multiply the EPS in my first metric and the lowest yield in my second metric. My entry price is here with PEs and multiples. If you want to pay premium for the stock, which I don't promote doing, I don't do it myself. Just in case you wanted to buy stocks at a premium, I've included my multiples here. That's how I did it, guys. And I did it with the other 50 stocks. This three metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.